After 2 years of pain for homebuyers, Fannie Mae is now predicting rates could go to 5.8% by the end, or not by the end, but by 2026.
Yeah, I think this is good news.
Go to 5.
You know, what we have happening now is that if you go back just a few months ago, it wasn't good, right? And so they're basically saying that it's going to be under 6% by the end of next year. So that's a year and a half. For a lot of you, that seems like a lot. But this is actually quite normal. And I don't know. What do you think? Fed's going to be meeting next week, 17th, 18th?
Well, there's reasons this is important. So one, a drop in rates is going to pull more buyers off the sidelines. We keep telling everyone this is a great time to buy. It's a buyer's market because you can negotiate right now. And, about a month and a half ago, we had a random weekend where rates, for whatever reason, dipped to 6.25, and there's a lot of home purchases. People came out in droves. So as rates start to lower, it's a mental thing, right? So people know when rates go down, historically, prices go up because everyone's solving to their monthly payment. Well, if things start to go down, then buyers are going to come out because they're not going to want to miss out before prices start to rise.
Yeah, and I think if you go look at their forecast, they just came out with a forecast. They've got what's called the National Housing Survey. Just go on their website. It just came out this morning, actually. It's the Home Purchase Sentiment Index, and it's ticking up. This is good because just in 2023, it was not good. It was in the 50s. It was like 58. Now it's up at like 73.5. So this is very, very good news, obviously, as they look at it. And for those of you who may not know who Fannie Mae is, they've been around since 1938. It's a government-sponsored, and they're the largest, though there's two. There's Freddie and Fannie, buyer of second mortgages. And so they have how they work, by the way, is if you guys go through, let's say, a lender, it doesn't matter who. Fannie or Freddie buys those from them and pulls them in what's called a mortgage-backed securities market to free up the liquidity for the lender, essentially. So it's a secondary market, but they are big, and they have a very, very, very good pulse on what's going on with single family.
And I think it's also important to note is that all these people that are in really high mortgages right now, 6.5%, 7% mortgages, will then all be able to refinance into these lower rates. And everyone out there saying there's going to be this huge real estate crash and people are going to have to sell. We've already told you that most mortgages right now are under 5% because of the big refinancing that went on in 2020. The people that did buy in 2022 on are experiencing much higher rates and much larger payments. So if anyone would make sense to walk away, it would be those people. But if you give them the chance to refinance into a lower payment, then it starts to tip in the favor of why would they walk away from that, right? So these lower rates are going to, diminish the potential for a housing market crash.
Yeah, and so if you take a look at Fannie, okay, what they have is they projected that the total sales for the year is going to be right around 5 million, and I think that's positive, right? It's actually 4.94, with 4.24 being existing, so that's pretty healthy, I think.
Yeah. So okay. So let's talk about, let's just cut it.
No. Yeah. What are you doing? Let's go right here.
Okay. So let's talk about the bond market because that's going to dictate kind of what these yields do. So mortgage rates typically track the 10-year Treasury yield cycle. And Fannie Mae is predicting this is going to fall around 4.2%.
Right. So the 10-year, guys, as you know, is a very, very important indicator for lots of things. What it really does is it's a big indicator for commercial, right? And the 10-year not long ago was down in like 3.6. Right now it's like 4.4, I think 4.45, and they're projecting it to go down to 4.2. This is really also good news for mortgage rates, right?
Yeah, and the reason it's doing that, so a lot of you know that the bond market is going to obviously dictate rates even more so than the Fed. But what you don't know is there's been some stealth quantitative easing going on, which has lowered the bond market.
This is important, by the way.
Yeah.
This is not making headlines. This QE. We talked about this a couple weeks ago, but it still is continuing.
Yeah, the Fed just recently purchased $43.6 billion in U.S. Treasury bonds. And the Fed's actions amount to a form of quantitative easing that is going to boost economic activity and also give a basis for rates to lower.
Yeah, and they also purchased another $8.8 billion in 30-year Treasuries. So what's happening is they're not waiting for Powell. Mm-hmm. Essentially, like this has really been very, very interesting, right? They're not waiting for the next week, right? They're basically try to control this today by doing this bond purchasing, and I think that. This has been happening before, this is actually what I think we sold these off, and it kind of got to where we are, and now they're just purchasing again. So my guess is this is another tool in the toolbox that we might see a little bit more of.
Yeah, absolutely. And I think that they know that there is a pullback coming in the economy, and basically one thing is going to break off first. And if the sell-off is first, then they're going to have to come in with quantitative easing. And if quantitative easing starts first, there's obviously going to be a run on prices again because it's going to be cheap and easy money.
Yeah. On the flip side of that, guys, as we talked about before, there's a lot of trapped equity, first of all. And so there's a lot of people in that 3-4% range right now. And so that is still going to be... Who knows? Like if you guys personally are saying, I was just talking to somebody the other day that had like a less than a 3%. A lot of people have less than 3% mortgages. Like, why would you want to trade that out for 5.8 next year? Right?
Yeah, it's not even that great for you. I don't think it really benefits those that want to sell. I really think it benefits those that are in high rates right now that need to refinance and that have been waiting to get out of these super high payments. Because if it does go to 5.8, that's not really that's a pretty decent mortgage payment.
And that's next year.
Right.
They're projecting that for like a year from now. So
well, and I think it's important to note too, it's that they just changed this because 3 months ago, they had it.
It was bad.
Yeah. So it was higher. So, now it's starting to lower. So we could see that continue to lower. But I think what's important is that, Fannie Mae is a big lender. And I think that they are seeing the writing on the wall and they know that mortgage rates are going to start to lower. And that should signal you as somebody that's looking to potentially buy that this might be your window before more buyers flood the market. Because the one thing is as soon as investments start to make sense again, you'll have the whole investor class that you're competing with. Right now with these rates, no investment or hardly any investment really makes sense in the single family market unless you have a very large down payment. So investors are traditionally sitting on the sidelines and they're the ones that come in with cash offers and all the different things we saw in 2020. So if rates start, now it's kind of a window where there's not a lot of buyers and you have a lot of negotiating power.
Yeah, the one thing that is creeping up is the number of listings. Mm-hmm. So we are seeing days on market, the number of listings longer. If you want to flip over to the commercial side of the equation, the multifamily side, I did a presentation at Rebel Capitalist. There was a property that I got from a broker. It was 250 units outside of Dallas, 35% occupied. There was a 25% mortgage on it, and the lender was willing to sell it for $14 million. So the lender would have taken a $14 million hit. Now that's the lender, plus the equity is gone. Now I passed on this deal because it was a mess. Like there was all these other issues, but so what we're also starting to see on the multifamily side of the equation, and of course on the office buildings, et cetera, is as these loans start to mature, and they are, and as these syndicators run out of money, you're going to start to see some of these bigger projects also, non-single family, start hitting the markets. We're already starting to see them. I got another call from a broker out of San Antonio last week. They got 9 deals where the lenders, what he said, have the keys. And I'm looking at one of those 9. So, we are starting to see a little bit of an unraveling here on the commercial side.
Absolutely. And I also think you need to look at Fannie Mae reported growth and cooling inflation. So Fannie Mae has lowered its GDP growth forecast to 0.7% in 2025 and 2% in 2026, reflecting softer economic momentum. And they're also expecting core inflation to go down to 3.8% in 2025 and 2.6% in 2026. And this economic backdrop will support lower interest rates.
I don't know about that, though. I mean, I don't know this inflation number. It just seems like it's not getting any better. One of the things that we've been talking about are the rising HOA costs. So if you guys are sitting in any kind of an HOA, I talked to a friend yesterday where their HOA went up $150 a month. And so you're starting to see, so we do expect with the lower rate for the mortgage to come down, $200-300, I guess, based on a $400,000 mortgage. But you also got to take a look at these HOAs and the operating costs of what it costs to operate a real estate deal. So whether it's a master plan like with an HOA or it's just a single family that you own. We are seeing property costs go up, utility costs go up. We're seeing insurance costs go up. We're seeing labor and maintenance costs go up. So all of that is also going to play into this next 18 months, right? So I think that unfortunately we could get to basically a net if we see I know everybody's got a rosy picture on inflation, but I don't see inflation coming back and pulling back, like some of the numbers that Fannie said, especially with these tariffs and everything else that's sitting on the table.
Well, something else that's interesting about inflation is the Fed is discussing lowering their inflation hiring their inflation target.
Yeah, that's very interesting.
So basically, essentially admitting that they might not be able to hit 2, and I think they had discussed raising it to 2.3 or 2.4.
Basically what that means, guys, is it means that the government, or I should say the Fed, is actually targeting that if you're sitting in cash, you're in trouble because they're basically going to inflate it away. That's essentially what it means. That means that their target is 2. It's actually going to increase, and so that's not good news. If the target for inflation is higher, that means if you're sitting in anything that doesn't move with inflation, that you're actually moving backwards. So that's why this is really important. I actually had a conversation yesterday with Lawrence Lepard, Lepard. He wrote the book, The Big Print. We got him coming to Limitless, by the way. He's not on the website yet, but I just chatted with him yesterday. Great book, by the way. I'm on my second time of reading it. And I was mentioning this to him. I said, hey, did you see the Fed increase their target? And he's like, yeah.
Well, they haven't increased it. They're discussing it.
They're discussing it, yeah. And so what that really means is it's just disruptive. The sound money is disruptive. He calls it sound money. It basically means that if you're saving and you're essentially you're losing at least 2 to 3 to 4% a year on purchasing power on that money that you're saving. That's specifically why, if you go back and take a look at whatever it is, I use that insurance policy in my mom's house. I use that as an example. It's a great example. My dad passed away, and but before that, in the early '60s, he bought a $10,000 insurance policy, and he bought a $10,800 house, and which they still live in. My mom still lives in. Today, that house is worth over $700,000, and the insurance policy is still $10,000. That's the point, and the difference is really inflation, and so just be careful as we head into this next piece. I think that's the wild card that could really, really mess with all this stuff.
Right. Yeah, absolutely. But then in times of high inflation, you also have asset prices that rise.
Yeah,
so,
that's why you want to be in a hard asset, right?
Yeah.
And many would say that's why we're starting to see a run on silver and gold and all that. I mean, and we haven't even talked about the dollar. That's another issue.
Yeah, and you have to look. So historically, lower rates are stimulating home sales, and you have to remember Fannie Mae doesn't really have a dog in the fight. They back these loans, but there's really not a lot of incentive for them to make up data. And they've revised home sale forecasts higher. So now 4.9 million, partly because of these expected rate cuts. They really think as rates go down, more and more buyers are going to come to the market. And get us out of this frozen, stagnated market that we've been seeing in the last few months.
And it doesn't seem like much, but this recent forecast change is another 60,000 homes. So I think that's significant. Obviously, and the fact that I would keep watching this home purchase sentiment. The Freddie Mac and Fannie Mae really have a pulse on this secondary market, and I think that if you want to you really want to track this, you're going to want to make sure that it's trending up, and it seems to be trending up.
Yeah, absolutely. As they start to cut rates, it will. And so, can't reiterate enough that now is probably a good time to start looking and to kind of get into that buyer pool. The only thing that could really, I think, skew this data is one, if we had major inflation, which I think could happen too. And if we did have major inflation, then, how do you think that would change this data?
I think it's going to change it a lot. I still think that we're going to see inflation. I think that's going to be their biggest nemesis. I think we're going to see two things. We're going to see higher inflation as a result of everything we just discussed. And I think we're going to see higher unemployment. Mm-hmm. And I don't know about you guys, but this Chat GPT AI stuff is it's really affecting jobs. We're already seeing accounting, things like marketing. I have friends that are in the PR and marketing business, and content writing, legal. I have a friend that sold his company recently. I said, "Why did you do that?" He said, "Because in 5 years I'm going to be out of business." I actually ran a 12-page term sheet through ChatGPT recently, and I couldn't believe it. I couldn't believe what it gave me back pretty quickly. So why is that important? It's important because employers, employees are using these tools effectively, and some of these core things are going to be affected moving forward. It's not going to affect the trades, right? But it's definitely going to affect. I think it's going to hit call it that middle management, or more of the white collar, and I really think that we're going to see rising unemployment this year and certainly next year. And we're in the beginning of this, right? And I'm telling you, so those two things, I think we're going to have inflation and unemployment. I think the Fed's back's going to be up against the wall. Don't forget also, Chair Powell is out of there in a year.
Well, it'll be interesting, too, because mass unemployment can trigger things in the housing market. And somebody just commented that they work in AI Treasury, and they said that they think we're going to lose 60% of jobs within the next 5 years. And scarily enough, I don't think that number is super inaccurate. I don't know about 60 because people are slow to catch on to technology, but I mean, you could definitely have very high unemployment because of technology. But when there's a crisis like that, the government tends to step in. That is the one thing that we saw in COVID. When there's a crisis, the government is going to step in with payments. And, they're not just going to let people go unemployed and not be able to pay any of their bills.
Right. At the Rebel Capitalists Live, George Gammon and a couple of other panelists. By the way, we got Jeff Snyder, Brent Johnson, George Gammon all coming to Limitless. But they're projecting a 10% unemployment. Mm-hmm. And so that's going to be the discussion. Why? Why do you see that? And a lot of this is AI, ChatGPT driven. A lot of it's profitability and inflation as well.
And outsourcing as well.
And outsourcing as well. And what's interesting, whether you love Trump or hate him, this tax bill, this no tax under $250,000, is it 200 or 250 grand? I can't remember which.
Is he really doing that, or did he just say
I don't know. But okay. Here's the point. That would really help people. Think about that. Think about how much that would help people.
Do you think it would help them that much, though? Because the middle class doesn't really pay that much tax anyways.
They're the highest paid.
They usually get kind of...
I know a lower percentage if you talk about percentages, but I'm telling you, as it relates to the people, I think that I think any kind of relief, obviously we're talking about tips, we're talking about overtime, we're talking about all this other stuff. And I think that if we can give some relief, and by the way, doesn't just replace UBI or Universal Basic
getting
Income?
rid of the tip or getting rid of the
tax under that? Yes. I mean, instead of giving them a check, why not just give them the savings?
It does if they have a job, but as we were saying, there could be mass unemployment,
of course,
and then if there is, then they're not going to have a job. But I honestly don't think it would help that much because typically I think that most people get money back around tax time than pay it.
Well, if they don't have a job, they won't get money back.
Well, no, not
if
they
they're
don't
not
have
working,
a job.
they won't have tax.
Yeah.
So to your point.
But I do think that you're going to see, with AI, probably some kind of universal basic income, whether or not they call it that or it's
I think it's going to
credits and tax credits and all the, however it's set up, it's basically going to be stimulus, through this AI because people have to work.
I'm telling you, like, this is where it's headed. Yeah, the hardworking person that under that $200,000 threshold, that's who needs the help the most. They're paycheck to paycheck, and if you can help them on the tax side. Who cares? Obviously they have to figure out how to roll that into the other piece, because you can't do a tax cut on one side without rolling it on the other side to somebody else. But I think that will be huge, and I think that's a better way than just sending people money. I think giving them incentives or reducing their tax. By the way, there's other countries that do this. Finland does this. So we wouldn't be the first one.
I don't mind the idea. I just think that, with AI, these jobs just aren't going to be available, So if somebody's not working, because I think that's going to be the bigger issue with AI is just how much work are people going to have to even take a job? Because a lot of your middle management's going to be gone. I guess
if you take the position that they'll never work again.
I don't know. I just think it's going to be hard to find a job. I mean, if you're like a marketing person and, a marketing director, a lot of your marketing can just be done by AI. We're already starting to see that in our company. And so, these kind of positions, if you post on social media, like that job's going to be something you could do on AI. Yeah, which is exactly why I think unemployment's going to go up. Right. Yeah. So but I do think that people are resilient. I do think that if they're gonna start to figure out other ways to make money, like we all do, right? And so that's going to continue. And I do think that people are going to have to make money somehow. Yep. How everything shakes out, I don't know. Well, it could just be more government employment, because they don't do much. Could be. But the reality is, again, however they make money, they're going to have a tax bill. And if we can give them relief, then I think that's going to be good for them. Yep, absolutely. But keep watching this. Fannie Mae keeps up to date on this stuff. It's important. It's important to know what rates are projected to do, and we'll see if it changes. It's great news, guys, for the single-family home market, for sure. All right. See you next week.